All right, Gallup, New Mexico. This is Jason with Caldwell Banker High Desert Realty, and I wanted to thank you for joining me on this. It's going to be about a 25-minute presentation about does the next recession equal a housing crisis? And I want to share with you some great information because your largest investment, your house, is probably very important to your family. It's probably something that you guys want to protect at all costs. So what I want to do is get you some great information so you know where your house stands if we go into a recession. We're sitting here in April of 2020. Now, this presentation was actually prepared about 5 months ago in October, but I want you guys to know that a lot of this stuff still resonates. It's still pertinent, even though we're in the midst of a global pandemic with the coronavirus, COVID-19, going rampant right now. A lot of this stuff is still going to be pertinent. So I want to be sure you've got good information for you and your family when it comes to recession and how that's going to affect your real estate holdings. So that being said, upcoming recession, when will it happen? What will the impact be? Keep in mind that this presentation was actually prepared late October of 2019, and now we're sitting here in April of 2020, and we see that a recession is upon us. And I think you're going to see some of the great information that came from this presentation, 5-6 months ago, is actually spot on to what's happening right now. So I think that is a very accurate, if you will, projection of what's going on, and gives us an idea of what's going on. So that being said, let's just jump right in. All right, so first off, a lot of people think 2008 recession is what it's going to be if our housing, with our housing, if we go into a recession. And what I want to let you guys know is that's just not the case. 2008 was a very unique predicament that the housing market caused the recession. And so the Pulseonomics survey that you're looking at here is, what are the top 10 reasons that a recession would occur? And you can see that number one is trade policy, number two is stock market correction, and number three is a geopolitical event. Now, I don't know if this is exactly a geopolitical event that we're incurring right now, but we are going through a global pandemic. And what that means, quite frankly, is that there you are. Number three is I think that's a position that we're kind of in right now. You can see all the way down at number 9 is a housing slowdown or a housing shortage or housing issues, and you can see that that's one of the least reasons that we're going into a recession. So that being said, guys, some great information. This is not the 2008 recession, and I want to talk to you a little bit more about that as we continue. So they did a survey, and I think this was a Pulseonomics. I'm sorry, my video is sitting in the way of it, but I think this was a Pulseonomics survey, and what they said is when, percent of shoppers that expect a recession to occur and when they expect it to occur. And you saw that 53% of shoppers were expecting a recession to occur between late 2019 and sometime in 2020. Over 53%, and this actually came from a poll in August of 2019 with Realtor.com. So I want you guys to know that yes, people have been expecting and talking about a recession for a long time. And what I'm trying to do is get you the information so you recognize the recession from 2008 is not the recession we're about to go into, and what is going to be happening with your property values and your homes as you go along. So that being said, will the recession occur this year or next? And 42% of those who surveyed in March 19 said, it's going to occur, 2019 and 2020. By August of 2019, 57% of the people who were surveyed said that it's going to happen within the next 12 months. Ironically, here we are, just 8 months after this survey was completed, and here we are really facing a recession. So I think those are just, again, indicators, predictions of what's going on. And that's why I think, because those numbers are so accurate, I think you're also likely to see the real estate numbers as you go through the recession as being accurate as well. So this was kind of interesting. The question came up, what is, will the 2008 recession, this next recession that we go into, is it going to be the same or worse as the 2008 recession? and 57% of people said that it's going to be the same or worse than the 2008 recession. And so because of that graph right there, that statistic right there, is one of the reasons that I'm trying to do this presentation for you, because I want you to understand that the next recession is not going to be the 2008 recession. And I've got some data I'm going to show with you here in just a few minutes and such. But because of that fear, 57% as of August 2019 said that it's going to be the same or worse as the 2008 recession. That's just not being supported with the economic data and stuff like that. So I want to get you guys that good information. So here you go. 55% said it's going to be worse than 2008. Again, we want to try to quell your fears, because what happens, guys, is when people get scared, they make irrational decisions and they panic and they freak out. The ones who make all of the profit are the ones who sit there and let other people be fearful, and then they look for the opportunities inside of that. So this is something that's kind of popped up. Pulseonomics, Duke Survey, and National Association of Business and Economic members, and they said, hey, when is the next recession gonna be? And you guys see a significant number of folks said in 2020. Here we are in April 2020. We kind of anticipate by June of 2020, it'll be the first quarter of real significant downturn. And then by the time September 2020 rolls around, we will be in what's considered a recession. So I think these numbers, again, you can see that a lot of people from the Pulseonomics survey, Duke survey of CFOs, and then the National Association of Business Economic members all predicted that it's going to be happening in 2020. So that shouldn't come as a surprise. Now, here you go. When will the next recession begin? This was another survey, 43.2%. All those people from Duke Economic, Pulseonomics, and the National Business Members Association, 43% of them said it's going to happen in 2020. Here we are in April 2020, and we can see it materializing over the next 3 to 6 months. So there you go. Now, just for definition, what is a recession? A recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by falling GDP in 2 successive quarters. So let me explain that the way I understand it in layman's terms. So let's just say, for example, the gross domestic product is all the stuff that we spend money on, that we serve, everything from travel to houses that you're buying, to stuff that you're buying at the grocery store, to the haircuts that you get. Basically, everything that the United States spends is what's considered the gross domestic product. When the gross domestic product is rising, it means that we as Americans are spending more. We're comfortable spending more. So if you have one quarter, let's say, where the gross domestic product is 3.6%, and then the second quarter is 3.5%, and then the third quarter it's 3.4%. Because that trend line is going down, that is what is defining as a recession. Now, even though something like that, 3% gross domestic product, would be significant for our country, even though that was the case, because it went 3.6, 3.5, 3.4, it's a trendward down, and that would be indicative of a what is defined as a recession. So recession does not equal a housing crisis. And I'm going to take you guys through some history here of what has traditionally happened with housing during recessions, with the exception of 2008. But it does likely mean that we're going to slow down a little bit on price appreciation and such like that. And I'm going to show you a little bit of that data here. So this was kind of good, is Morgan Housel on possible economic slowdown. He said, some will assume it's going to be as bad as 2008. It's been a while since the last recession, basically 12 years, and it's going to feel worse than it is. No matter what you do for a living or how you invest, there's going to be opportunities. And that's one of the reasons that I'm doing this video for you guys, is because there's going to be opportunities, and I want you guys to be aware of those opportunities as you are dealing with your real estate needs, so that way you can make good decisions for your family. So the financial panic of 2009 or 2007, 2009 was probably the main reason that the recession was so unusually deep. Now, this is Ben Bernanke. He was actually the chairman of the Fed. The financial panic, again, a lot of panic. The recession of 2008 did not have to be as bad as it was, but because there was a lot of panic around it, it caused us to go deeper into recession than what we needed. So here's Ben Bernanke again. He says, my results do suggest that in the absence of panic, the declines in employment, consumption, and output in the early stages of the Great Recession would have been significantly less severe. So because people were panicking, because people didn't have all of the information, they started running around like chickens with their head cut off, and they made the recession much worse than it needed to be. Ironically, the people that kept their heads made great money during the recession. They bought opportunity properties. They refinanced when interest rates were low, that type of stuff. And so again, one of the reasons I'm getting you guys this video, just to try to arm you with more information. Here's Warren Buffett. You know, guys, I've been talking about Warren Buffett a lot lately on my Facebook Live videos, and he looks, when there's a challenge out there, he looks for the opportunities inside the challenge. And, you know, Warren Buffett said, fear spread like a tsunami in 2008. And guess what? He's absolutely right. And that's why a lot of people lost, I mean, the shirt off of their back in 2008, and because they were panicking. Well, Warren Buffett looks for the opportunities in there, and that's where he makes a lot of money at. So a little historical norm here on housing prices in periods of a recession. And I want to let you guys know that the average historical property value gain in the United States is about 3.6%. So statistically, if you have a house in the United States that's worth $200,000, if you just hold on to that house for a year, the next year it's going to be worth about $207,000. So I want you guys to understand the historic norm of property value gains year over year in the United States is 3.6%. So you look at the 2008 chart, and my picture is down in there, it blocks out a little bit, but you can see that, you know, property values, home prices dropped, you know, 20%, like 18.7% in 2008. But if you look at the 4 recessions prior to that, you see something that's kind of unique. In 1980, property values actually jumped up 6.1%. Right around the recession. In 1981, they jumped up 3.5%. 1991, they took a little dip, but in 2001, they went up 6.6%. Now, the reason this is so important, guys, is remember, the average historical norm is only 3.6% property value gain. So if you look at 1980, 1981, and 2001, it was either at the historical norm or significantly higher. I have a theory about that, and my theory is that when the stock market is bouncing around like a ping pong, it's going up, it's going down, nobody knows what to do with it, people want to move their money into assets they can control. And believe it or not, real estate is a wonderful asset that you can control. And not only that, but also during recessions, um, rental properties tend to fill up very quickly and stay occupied, and rents tend to increase during a recession. The average rental price goes up. So again, why did property values go up during the recessions? That's my theory about it. I'm not an economist, and I'm certainly not the sharpest tool in the shed, but it seems logical to me. So that being said, guys, keep in mind that out of the last 5 recessions, property values jumped historic norms or better 3 out of the 5. So that just gives you a little bit of an idea of what's going on. So here's where the home price appreciation going forward. It's a survey from a various recognized leaders in the industry. You know, like the Mortgage Bankers Association, 4.7% in 2019. They're expecting 2020 for the appreciation to slow down a little bit to 3.5, and maybe in 2021 going to about 2.6. You look at the home price expectation survey, they predicted a 4.1% increase in 2019, a little bit of slowdown in 2020 as we go through a recession, but then by 2022, you see that they're starting to pick up again. So again, guys, you're seeing that property values, the appreciation of your property value might slow down a little bit, but it is not going to lose value. This is a great map of the United States that was just published in September of 2019. And what it is the probability of home prices being lower over the next 2 years. And what you're seeing in the United States, guys, we don't see any red, which is a moderate, you know, dip in home prices, or whatever. There's no red out there at all. You see a couple of states that, you know, there's a slowing of home prices or low growth of home prices, and then minimal growth of home prices being the darker blue. And you can see most of the United States is in that darker blue color. So again, this is just another survey that was taken. I think this one comes from Pulseonomics, and just keeping you informed that even though we might see a slowdown of appreciation, you're not going to see a dip in your home prices necessarily. One of the big reasons in that the housing bubble in 2008 collapsed was the debt loads of most Americans. And this report actually goes back 40 years from 1980 to 2019. And you can see that as we were up in 2007, specifically Q4 of 2007, the household debt service ratio for mortgages as a percentage of disposable income. So you see that we were way high in 2007 on our debt loads. People were refinancing their houses to go on cruises, take vacations, buy jet skis, those types of silly things, and they were carrying a lot of debt. Today, guys, most Americans are in a significant equity position on their properties. 70% of all Americans are in a 20% or better equity position on all of their properties. And so what that means to you, if you look at today's numbers versus 1980 Q1 numbers, the first quarter of 1980, we were at a 4.38% household debt servicing ratio. Today, you're at a 4.25%. And so we're actually lower on our debt ratios than we have been anytime over the last 40 years. This is another good indicator that we're not going to do 2008 all over again. Number of consumer foreclosures, and this is a great scale here. Another reason why we don't think, because there's still not a lot of inventory on the market and there's still a significant buyer demand. When you go out to 2008, for example, there was a lot of inventory on the market. Prices were still going up, even though there was a lot of inventory, and buyer demand was still kind of so-so. It was kind of a balanced market. But what you're seeing right now is we're actually at the lowest number of foreclosures really since, with the last 15, 20 years here. You look back, 2003, quarter one, there was 203,000 foreclosures, over, year over year. And then it peaks out at 2009, once we're going through the housing crisis bubble. But right now, on an annual basis, we're only selling nationwide about 71,000 foreclosures. Guys, that's actually lower than the numbers leading up to the 2008 housing crisis, going all the way back to 2003. So really, the number of consumers with new foreclosures is drastically reduced, and that's another indicator of why we don't think this is going to be 2008 all over. So this is what I want you guys to know. Uncertainty leads to confusion. Confusion leads to concern. Concern leads to fear. Fear turns into panic, and panic causes paralysis. Again, the reason I want you guys to have this information and have this video is I don't want you to have fear. Yes, you can be concerned and you can even be confused. I mean, if you type in Google, recession and property values, guys, you're probably going to have, hundreds of things pop up, and it's so overwhelming to try to take in all of that information and such like that. But I do want you guys to know that this is information that's based on economic data and factual data that's coming from, various agencies like Pulseonomics, National Association of Realtors, Mortgage Bankers Association, the Federal Reserve even pumped in some information in these reports. So what I want you guys to understand is that yes, it's okay to be concerned, but don't let that concern turn into fear and panic. When you're concerned, it just means you need a little bit more information. And again, that's why we're trying to do this type of video, so that way you know what's going on. So this was kind of good. This is Danielle Hale. She's Realtor.com's chief economist, and she says, when the U.S. enters its next recession, it's unlikely that the housing market will see a sharp nationwide downturn. The same record low inventory levels that have made home buying difficult recently will likely protect home prices in the next recession. So as I was telling you just a few minutes ago, there's still not a lot of inventory out there, but there is a lot of buyer demand. And so what that means is that it's unlikely that home prices are going to take a big dip, because home prices are based on supply and demand. If there's an oversupply of something, prices go down when demand goes down. But when there's not a lot of the supply, and in this case, a significant number of demand, i.e. buyers, prices tend to remain stable or still continue to rise. So that's what Danielle Hill is talking about as the chief economist over at Realtor.com. Morgan Housel, the financial analyst, he's said that an interesting thing in the widespread assumption that the next recession will be as bad as 2008, it's natural to think that way, but statistically, it's highly unlikely. Could be over before you realized it began. And so again, this is why I want you guys to have this information for your properties, because I don't want you to have to panic when you hear that we're going into a recession and think it's going to be doom and gloom all over again. So a little bit of information, guys, just so you know. I mean, we're getting this. I get this information from a bunch of different things that come from a bunch of different resources, and these are things that we got to talk about. Is past recessions. How long did they last? What happened to property values during that time? What's going to cause the recession? What's the definition of a recession? Impact. What's going to happen on this? And so, guys, I want you to know that we're pulling this data from a variety of sources and such like that, just to try to be a better resource for you. The bottom line out of this is I want you guys to understand recession does not equal a housing crisis. Right now, there's still a shortage of inventory and a significant demand. And if anything, I think this is going to continue for some time, because when you're in a recession, property values, or excuse me, interest rates, mortgages and such, tend to be very, very low. And they tend to be very, very low because the Federal Reserve is trying to incite people to buy and such like that. So that being said, I don't think that this is going to be, I mean, there's still a lot of buyer demand out there. And if interest rates continue to stay low like they are today, they're in like the 3% range, that means people are still going to want to buy properties. I think what you're going to see is a slowdown in the appreciation of the values of your house. Where, last year in Gallup 2019, we had 7% higher sales prices than we did the year before. I think that's going to slow down to about 3 to 4% or what have you. But it does not mean that you're losing value on your house time and time again. So that being said, guys, this is Jason with Caldwell Banker High Desert Realty. If you have more questions and concerns, give us a call and set up an appointment with me. My phone number is 505-863-4363, or my cell phone is 575-496-1068. I do appreciate you joining me. I told you I was going to keep it down to about 20-25 minutes. I hope you got some great information here, and I'm looking forward to hearing what you have to say about it. Thanks so much. Take care. Bye-bye.